Let's bring on board then Phani Sekhar, who joins in to give us some perspective on which way the market's heading, and run us through, where exactly you see a bottom in this sort of a market and what exactly you think is causing such acute selling pressure post the budget.
Hi, good afternoon. I think the primary cause of the nervousness that you are seeing right now, despite an encouraging repo rate cut, has got to do with what's happening in New Delhi. The basic cause for enthusiasm in the budget was enhanced allocations to infrastructure, including railways. So roads and railways combined had an allocation of more than 45%. But for the infrastructure allocations to really fructify on the ground, key legislations like land acquisition have to go through. And it seems almost certain now that while these legislations have been introduced in the budget session, they might not go through in budget session, which means they will have to come back in the monsoon session, and then we don't know what happens then. So if passage of such key legislations is delayed, then although the budgetary allocations look very impressive, they might not completely pan out on the ground, and this is something that is causing some amount of anxiety in the market, because a large part of your growth hypothesis is centered around how effectively public expenditure will kickstart growth. And if public expenditures were to get delayed because of lack of legislations, then of course the entire growth hypothesis, around 18% corporate earnings growth that one is working with on the back of 8 to 8.5% GDP growth assumption, will come under question. I think the combination of these factors is pulling the market down. And till you see some kind of clarity emerging from New Delhi, I believe there might be some nervousness. Having said that, the market is likely to find a bottom, maybe 3 to 4% lower, because at levels closer to 8,500, the market will become attractive at around 14.5, 15 times 1 year forward, and that will attract a lot of long-term money. Because let me be clear that nobody is selling down the India story. What is happening is at levels closer to 9,000, maybe at around valuations closer to 17 times, investors are asking some tough questions. So, a 500-point correction is not such a bad thing in Nifty if it brings long-term money and puts some pressure on the government to perform.
So, Phani, what do you buy then if we were to decline further from here? Do you buy the leaders of the last bull run, the likes of private banks, pharmaceuticals, etc.? Or do you think the texture of the market, whenever it were to go up after bottoming out in the near term, would be a little different?
Well, since the market is not likely to go up in a straight line, I think the broad composition of the portfolio has to have a growth skew with a healthy participation of defensives. So you must have the FMCGs and pharmaceuticals in your portfolio. But private banks are the best proxy to growth. So while I'm not a great believer in going overweight on infrastructure at this point in time, but I guess private banks and a tinge of large public sector banks like an SBI or BOB might be a good idea at this point in time on declines. So as and when, and even though the market might decline, it is always possible that there might be an equally sharp bounce back to levels closer to 9,000. So this kind of volatile market action is something that is likely to continue till you see the next round of policy action. So I believe it's a good idea to tank up on some of these good quality private banks or good quality PSU banks on decline. And that is likely to give you the outperforming trades.
Phani, thanks so much for joining in and giving us a view. So it would be prudent to put your money into defensives, FMCG, pharma was recommended, and private sector banks is the best bet according to Phani. Well, let's move right on and get in some technical